Are more expensive properties outgrowing cheaper properties here in Australia? It's been a long topic of debate here on YouTube. Should you buy 3 cheapy investment properties or 1 expensive blue chip property? In this video, we're going to be breaking down my thoughts on whether you should buy cheap or expensive assets and which style of asset is growing faster at this point in time in Australia's property market. My name's Luke. I talk all things real estate, renovating and financial freedom here on the channel. If you enjoy my videos, make sure you subscribe and drop a like down below and head over to purposeproperty.com.au if you're looking for a Brisbane-based buyer's agent. Now let's dive straight into today's topic and break it down. So, are pricier properties outperforming affordable homes? The market is currently going through a period of high interest rates and higher median prices, making it difficult for many people to buy property, and that's very much the case. Higher home loan rates have reduced buyers' borrowing power, leading to increased demand and higher growth rates for more affordable properties. Now, what a kicker to start off with. This is exactly what we've seen on the ground here in Southeast Queensland in the buyer's agency. The last 6 months has been hectic for houses and townhouses and units at that $300,000 to $700,000 mark. In those first home buyer ranges and the price ranges a lot of investors like to buy as well. The reason being is that floor is being pushed up by a high level of demand. It's also very expensive for people to create new stock. Expensive to get new titles, expensive to get tradies out, expensive to create new property. And so what this means is the established property that was at cheaper price points the last 6 months, in my opinion, has significantly outpaced the growth of your $2 to $3 million homes. And that's because we're seeing this flight to affordability. The latest data confirms this trend, but it also shows significant growth in the high-end market, which is really interesting given that we're in this higher interest rate environment. So supply and demand are the main drivers of property price growth, which is basic economics. And the data indicates that demand for expensive properties is as strong as that for the cheaper ones. How interesting. While many buyers are adjusting their budgets and purchasing more affordable homes, others are not restricted by price, which means the super wealthy aren't leveraging debt to buy these expensive homes. They're leveraging business revenue and take-home cash to buy these really expensive properties, which means they're less affected by the interest rates. By analysing the percentile sales data, which shows price growth rates across different market segments, we see a clearer picture. A percentile is a statistical measure indicating the relative position of value within a data set. Throughout the pandemic, high percentile prices increased faster than lower percentile prices. So this is what you can see on screen here. So you've got the percentiles of where property values sit on the National Price Growth Index, and we've got 2020 out to 2024. So you can see these expensive properties from 2021 to 2022 far outpaced the lower price properties. But now we can see that the trajectory of all these types of properties, whether they sit in the most expensive band or the cheaper band of percentile, we can see that they're all kind of on the same trajectory here. So the lower priced properties, you can see you've got the pinky color and the blue color here. That's where we're seeing that stronger growth. But your very high-end properties, so in the 85th to 95th percentile, are growing at a faster rate. Interesting point being is that those medium properties, so in Brisbane, for example, the $1.2 million mark, maybe you're not seeing as much growth as those other styles of assets at the top and bottom end. Now, what are some of the factors that have contributed to the growth in property prices? The rental crisis in Australia has driven many renters to buy, with first-home buyers opting for smaller and cheaper properties, which is why we've seen that boom in the townhouses and the apartment space the last 6 or so months. In addition, investors have re-entered the market favouring more affordable properties. As investors always do, they generally are capped on their serviceability and therefore they're buying cheaper assets. Due to higher interest rates, many buyers are restricted to buy these cheaper properties, increasing demand and driving up prices in these lower percentiles. One of the really interesting things I'm seeing in the buyer's agency is my recommendation to buyers to actually buy just outside of these price ranges. So if you're able to afford an $800,000 to $1.2 million range, so closer to the median percentiles that we were looking at, I actually think there's better value buying in those price ranges at this point in time. If you're competing at a $500,000, $600,000 price point at this point for houses or townhouses, or even units in inner city areas, we're seeing significant demand, 10 plus offers on those types of properties. Whereas if you're able to buy in that $700,000 to $1.2 million range, there might be less competition, but still really good growth potential in the mid to long term. And so if you're able to buy with great value, that's what I've just bought. I've just bought a property for $855,000, and I didn't have to compete with a lot of those investors in the lower price points and a lot of those first home buyers, which are pushing up those lower prices. So just something to think about in terms of price. So it's also interesting to look at the year-on-year growth data, which highlights the different trends across the different capital cities. And everyone loves talking about what's growing faster across Australia. So let's break it down. This is the year-on-year price growth by price percentile. So we've got Australia as a whole, Adelaide, Brisbane, Perth, and Sydney. And so this is showing the growth in each of those percentiles, so your cheapy properties and your expensive properties in each of the capital cities. So you can see Adelaide, Brisbane, and Perth are star performers, and everyone knows this from the last 24 months. Sydney has actually had some stronger growth in their 75th to 85th percentiles, which are probably those more affluent areas, so 2 to 4 million, where people are looking to stretch and get into those higher price brackets in those sought after areas. So that might be why that's having some higher growth there. You can see Canberra and Hobart and Melbourne. Well, Melbourne's stagnant and Canberra and Hobart have gone backwards. That's because Canberra's largely driven by the politics. But really interesting to me is that you can see the growth here in the lower price properties here in Brisbane. Adelaide, interestingly enough, is the higher and lower. And then Perth is just the lower end, having the stronger growth over the higher price properties. Overall, all those properties year on year have grown over 10%. So if you bought lower, middle, or upper percentiles, you still had 10% plus growth on average. But there's a difference in certain areas with the affordable properties and most of those growth cities outperforming the higher price properties. Now, it's important to remember that you're not buying the median property. You know, you might buy a lower percentile, but that doesn't mean you're going to guarantee stronger growth than the upper percentiles, because every property is different. And so yes, it's important to look at the growth trajectory, but I'm not a short-term investor. I'm not looking at just the next 6 to 12 months. I'm looking at the next 3 years, 5 years, 10 years in terms of the market growth. And that's why I'm so bullish on Southeast Queensland over Perth and Adelaide. I think Adelaide might actually stagnate over the next 24 months. And Perth may continue to be bullish, but I think the growth there is heavily investor driven. And that's why Perth has grown so significantly. And it's also going through a catch-up phase. So don't get me wrong, Perth might still grow, but I'm putting my money where my mouth is, and I've bought 4 houses here in Southeast Queensland. I don't just own property here in Southeast Queensland. We own a unit block in Coffs Harbour, which is a major regional market. And so we're diversifying across states and across asset types to give ourselves a reasonable amount of exposure. So to close this out, let's look at some of the percentiles in dollar terms, because I think it's really interesting to see the dollar amounts, especially if you're looking to invest in Brisbane or any of these states for that matter, and looking at where the median prices sit. So as we were looking at Brisbane, you can see that 600K is the lowest percentile, 660, 25th, 840 is the median price, and then you're looking at 75th, 85th, and 95th. Oh, I wasn't far off with Sydney. You can see those Sydney prices is $2.2 to $2.8 million. And so that's where I was saying that those affluent areas, people are looking to upgrade. That's why there's been some strong growth in those markets, because people are pushing to get into those sought after areas. So in Brisbane, if you're going to be buying a property at or below 660K, you're in the bottom 25th percentile in terms of price point. That's why I'm seeing value between that, say, 700 to 1.2, which is where you're sitting between the median and 75th percentile. The reason I really like that value is, again, the scarcity, and there's less buyers in that area because they can't necessarily afford it today. But in the future, those areas are going to be sought after, like you're seeing in Sydney, those sought after areas being chased after. That's why I'm buying in that price point myself at this point in time. So this is covering off on houses. Let's have a quick look at units. You can see units here are a bit more affordable in Brisbane's case, so 400, 455, 550, and 700 plus. And then you're looking at the affluent end at $1.1 million, which is 1K, 2Ks from the city. When we've been helping clients buy units, which we do, we generally like to buy land because that's the scarce asset. When we do help clients buy units because that's what they want, you're probably looking around that 550 or 600,000 at this point in time to get into the inner middle ring of Brisbane. So the real question is, should you buy expensive properties or cheap properties? And what's the best solution? Now, depending on which YouTuber you're listening to, because I know if you're listening to my videos, you're probably listening to a lot of other property YouTubers. It depends on your your strategy. So some of the guys out here on YouTube have the strategy to buy tons of cheap properties, let the floor be lifted in the property market over time by inflation, and build out the asset base that way. They're going to have a slightly higher rental yield, but if you have an aircon blow or you have maintenance blowouts or you have problems, that can really hurt your net cash flow, because an aircon should roughly cost the same on $1 million home as it does on a $300,000 unit. Now, I don't mind that strategy of buying the cheaper properties if you're struggling for cash flow and you're struggling for serviceability. That can be a valid strategy for some people. On the flip side, you've got guys out here on YouTube. I can think of guys out in Sydney. I won't name names, but they're very blue chip focused. Forget about the cash flow. Don't worry about it. Buy the best asset you can afford. Buy blue chip Sydney, buy blue chip Brisbane, blue chip Melbourne, and hold for the long term. Now, again, a valid strategy. There's no necessarily right or wrong when it comes to property investing. There's what's right or wrong for your own situation. And so in that circumstance, when you're buying the blue chip assets, you need to have obviously a large amount of capital behind you to buy those blue chip properties. But I do like that you're buying scarcity. You're buying those locations that are sought after, that you're always going to have rented, but you have to accept a lower rental yield and potentially significantly being negatively geared on those assets as well. For me, I've gone with growth first, cash flow second, and generally I prefer larger asset prices because it means I need to purchase less properties. It doesn't mean I won't purchase cheaper properties, but at this point in time, given where the prices have moved the last 6 months, I've purchased around the median price point if we looked at those data sets. I've purchased 2 properties this year, one around 640K, which is in an area that's about 800,000 for similar assets, and another property for $855,000. So both my purchases end up around that 800K mark. In our own property portfolio journey, we bought 3 blue chip houses here in Southeast Queensland and manufactured value on each of those deals to fast track our journey. We then refinanced, pulled out the equity on each of those deals, and bought the unit block in Coffs Harbour, which if you break it down is more like buying, $400,000 assets. So a number of cheaper assets, but because we bought the unit block, we've got a bit of economies of scale and a bit of better pricing there as well. So in my journey, that's why we've gone for growth first and cash flow second, is because you need the growth to equity harvest or to refinance out of each of those assets. And then you want to balance out and buy the cash flow and buy the cheaper properties over time to give yourself stronger cash flow, to maybe add dual occupancies or buy unit blocks in my case. And on these recent purchases, we're also looking to add granny flats or do subdivisions. My overarching strategy is to go for the higher price point growth properties first, and then to go for more affordable or more cash flowing assets second. Now, like I said, there's no right or wrong. There's guys that advocate heavily for just blue chip, heavily for just cheap. I'm probably one of those advocates of somewhere in the middle, but you need to look at what you can afford. If you can only afford cheap properties, then I agree, break into the market, buy what you can afford and start there. You've got to start somewhere. Buy what you can afford. But in my opinion, if you've got the serviceability and the ability to buy a higher price point property, that's what I'm doing at this point in time in Southeast Queensland. I'd love to hear your thoughts in the comments below. Should you be buying cheapy properties or expensive properties? What's going to grow faster over the next 12 months and what's going to grow more over the next 12 years? If you want to see me break down a playlist of some recent client purchases and you can see the specific price point and the specific addresses of each of those deals, then make sure you click this playlist over here. And head over to purposeproperty.com.au if you're looking for a buyer's agent or you want a real estate investing course. Thanks for sticking around. I'll see you in the next one. Peace.